especially for people who can't afford to buy 100 shares. Okay, so this strategy is called a bull put spread. A bull put spread. Okay, also known as a credit spread. So this strategy allows you to create regular income with limited risk, with limited capital, and a 75% win rate on average. Again, sometimes it's higher, sometimes it's lower, but that's a rough average. Okay, so you want to learn this strategy? You guys, are you guys still with me? Okay. So let's learn this strategy here. Okay. Now, so once again, let me just say this. Please, if you're trading this, only do this on big companies. Don't do this on penny stocks. Don't do this on small companies. Do this on big companies. Ideally, companies in the S&P 500 or the Dow Jones companies, right? Companies that have a market value of at least 10 to 20 billion dollars. We want good companies, safe companies, all right? So must be fundamentally good company and large company worth at least $10 billion, all right? Okay. And you want to make sure that it's on an uptrend, right? It must be on an uptrend like that, right? Like uptrend, wave up, wave down, right? It must be a nice uptrend, right? You don't do it on a downtrend. That's dumb, okay? Don't do it. You must be on an uptrend, right? Okay. Yes, you can do it on indexes, Frank, and ETFs as well. No problem, right? Okay. So what's the strategy? Very simple. Here's the strategy. So we find a good company that's on an uptrend. So on an uptrend, the probability is that we expect the price to keep going up, right? Correct? On an uptrend, okay? So what we do is this. The first thing we do is we sell a put option far away from the current price. We call it out of the money. OTM means out of the money, which means the put option, the strike price, is far below the current price. Now again, why do we sell this put option? Why? To collect premium, correct? Which is what we did just now. But by selling the put option, you are obligated to buy the 100 shares. But you say, I don't want to buy the 100 shares. I don't want to be a father. I can't afford to be a father. So what do? Use protection. So what we do is simultaneously, as we sell the put, we buy another put. So we sell the put here, we buy another put below that, okay, to protect this first guy. It's kind of like you sell insurance and you buy reinsurance. Okay, you sell insurance, you buy reinsurance. So it's kind of like you are obligated to buy 100 shares, but with buying the put, you have the right to sell 100 shares. So you can buy the shares and sell the shares and you are hedged. You are safe. Got it? Now, these two puts must have the same date to expiration, which is again 30 to 45 days. All right. Now, when you sell this first put, you collect a premium of say $1, right? You collect $1 premium. Okay. Now, when you buy a put, you have to what? When you sell a put, you collect money, right? But when you buy a put, you have to pay money. You have to pay a premium. But this put, because it's further away, the put is cheaper. So you buy at a lower price. So maybe you buy this put and you have to pay 80 cents, for example. So you collect $1 here and you pay 80 cents, you are still up 20 cents. We call this a credit. So that's why it's called a credit spread. Why is it a credit spread? Because the moment you enter the trade, you are paid money to enter it. It's a net credit. Got it? Okay. And this trade lasts 30 to 45 days. Of course, you can get out as early as you want, but the max, it will last 30 to 45 days. So does this make sense so far? Okay. So let's go into detail. So once again, you want to only do this on fundamentally good stocks that are big companies. And you want to do it when they have got high implied volatility. So what does it mean? You want to do it when the stock has high volatility. Why? Because when volatility is high, options are expensive. And when options are expensive, you collect more premium and it's more worth your while. So we want the IV rank to be above 35% ideally. Now, later I'm going to show you we have an indicator to calculate the IV rank, right? It's a proprietary indicator that we develop, right, to see the IV rank. So in a short while, right? So once again, make sure you do it on a stock that is on a uptrend or downtrend, guys. You tell me. I need to make sure that you guys understand this. Uptrend or downtrend? Uptrend, okay? So uptrend, a wave up, wave down, wave up, wave down, wave up, wave down, wave up. Wait for a wave what? Wait for a wave. Wait for a wave down. And you want to wait for a wave down to a strong support level. You got to wait for it to hit a strong support level so the price is likely to keep going up. Okay, it must be at a strong support level on an uptrend. Very important. Okay, now, so once you're here, you say, okay, I think the stock is gonna keep going up, or at least stay there, right? So what do you do? What's the first thing you do? You sell an out of the money put at 20 to 25 delta. Now, what does delta mean? Later, I'll show you on the option chart, okay? Basically, 20 to 25 delta is an estimation that tells us that there's a 25% chance that this put will expire in the money. All right, so what does it mean? Let me just click on this. Okay, so I'm going to sell a put option at 20 to 25 delta. That means there's only a 20 to 25% chance that the price will drop below this level and stay there. Only a 20 to 25% chance, which means there's a 75% to 80% chance the price will not go below this level. It will stay above this level. And that's why this strategy theoretically has a 75% win rate, because 75% of the time, it will not stay below this level. It would remain above this level. Does this make sense? That's why we choose 20 to 25 delta. Okay. So once again, we sell this put, and what do? We buy another put to protect this put. So we sell insurance and we buy reinsurance. Okay. So we sell the put for $1, we buy another put for 80 cents. So net, we get a credit. Now, some people say, Adam, this sounds complicated. Why don't I just buy the done stock? Just buy a stock or buy the call option. Why don't you just do that? Okay, you see, if you buy a call option here or you buy a stock, guess what? You only make money if the price goes up, right? But if the price goes sideways, you don't make money. The price goes down, you don't make money. Okay, so you only make money if it goes up fast enough when you buy a call option or if you buy the stock, right? Now, what I love about this strategy is this. In this strategy, if the stock goes up like crazy, you make money. If the stock goes up slowly, you also make money. If the stock goes sideways, you also make money. Even the stock drops, you also make money. As long as it doesn't go below this level. So you've got a very wide profit zone. Okay? Could you lose money? Of course you can lose money. You lose money only if there's a crash. Only if there's a crash. So the probability of making money is much higher. But there is still a chance of losing money, of course. So later I'm going to show you how and when I cut my loss if there is a crash. It will happen. It all definitely will happen, right? Okay. So shall we look at a real life example? Okay, let me take an example right now. So let's look at this stock called Restoration Hardware, RH. Now, again, bear in mind, the market is closed now. So all the prices that you see will change when the market opens on Monday. So for this strategy, you have to wait for the market to open to analyze the trade and to decide to enter it. You can't do it before the market opens because the prices will change later. But I'm just showing this to you for educational reasons, right? But when on Monday comes, I may not do this because the prices will change then. You follow that? Okay, so please understand that. Okay, good. So let's look at RH as an example. And let me just remove this. Okay, so first of all, what do we want to check? Is RH on an uptrend? Does it look like an uptrend? Wave up, wave down, wave up, wave down, wave up. Yes, it's on an uptrend. And now it waved down to a what? It's at a what? Is at a what? Support level. That's right. It needs to be a support level here. So it looks like it's at a support level. Okay. Now, for this strategy, you don't have to care about intrinsic value because you're not actually going to own the shares. This is a one-night stand. You are using protection, right? So you don't care about intrinsic value. You just need it to be on an uptrend and it's a big company. That's it. All right. Now look at this. Can you see IV rank here? The IV rank is 49%, which means the options are expensive, which means when you sell the options, you get a lot of premium, right? So IV rank above 35%. So again, this is a proprietary indicator that you will get when you sign up for the options course. You'll be getting all these indicators as part of the course. Okay, so what's the current price now of RH? Current price is $690, right? That is my current price right now. Okay, so what's the first thing I want to do? What am I going to do now? I'm going to sell a put option, right? Okay, let's remember what's our strategy here. The first thing we do is we sell a put option at 20 to 25 delta and then buy another put lower down to protect the first put. Okay, so let's go to the trade tab. And I have to choose a date to expiration. I could choose 24th September or I could choose 1st October. Either one is fine. Okay, so normally I like to choose the one closer to 45 days. Let's open this guy. Boom. All right. Then we look at puts. Okay, now can you see delta here? Delta. So we're looking at 20 to 25 delta for this strategy. So there, 25, right? Or 22 or 20. So we can take, between 20 to 25. Of course, the lower the delta, the better, right? The lower the delta, the better, because the lower delta, it means that there's less chance for the stock to reach our strike price. Okay, the lower the better. But of course, it must be good enough that we get a good premium. So I'm going to choose to sell the 610 strike. Okay, so I'm going to sell the 610 strike. And if I sell this, how much money do I get? Okay, roughly I will get $18, right? This is the mark price. I'll get $18. I collect $18. Okay, so I sell insurance, I collect $18, but I need to buy reinsurance. So I need to buy the option below that. So what's below 610? The one below that is 600, right? Okay, so I'm going to sell this, collect $18, and buy this and pay $15.85. So do I get a net credit? Yes or no? I collect $18, I pay $15, I get a net credit of $2.20. Okay, so what I do is very simple. I click on sell, right? Click on sell, boom. Hold the control key, click on buy, boom. There we are. Okay, so minus one means you sell one contract. I sell one contract of the 610. I buy one contract of the 600. Net credit is $2.20. So one contract is 100 shares, right? So 220 times 100, how much money do I get? I get $220. You follow me so far? I get $220. Now, if you click this, you can see over here, my maximum profit is $220. Okay. Then you may say, Adam, there's a max loss, right? It's saying I could lose $780. Why would I want to risk more to make less? Hold on. There's a reason, right? Just bear with me for a while. But let me tell you the rule. The rule is this. Listen very carefully. The rule is this. For every $1 of credit we collect, the maximum risk that you see should be $4. I repeat that. For every $1 you collect, the maximum risk should be $4 or less. More than that, you do not take the trade. So in this case, 220 and 780 is 1:1. What's 780 divided by 220? 780 divided by 220 is you're risking you're collecting $1 and your maximum risk is $350. So is it within 1 to 4? Yes or no? Yes. So this passes our test. Okay. Now, I'll come back to that in a while. Now, in theory, if you do not manage the trade, could you lose 780? Yes, you can lose 780 if you do not manage the trade. That is why you have to learn to manage the trade so that you will never lose the maximum. All right. In fact, later I'm going to show you that the very most you will lose is 1.5 times the credit. So what is 1.5? That means if you're collecting 220, the maximum you should lose is 220 times 1.5. What's 220 times 1.5? 330. 330, yeah. Okay. So more on this later on. Right? I repeat, we're collecting 220, and in a losing trade, we should lose no more than 330. And you say, but Adam, why would I want to risk more and make less? This strategy, you can, because it's got a win rate of 70%, 75%, 80%. So when you've got a very high win rate, you can do this. It's, again, like selling insurance, right? How do insurance companies make money? They sell you car insurance, so they collect premium from drivers. They collect $1, right? Now, eventually, one idiot is going to have an accident, and the insurance company has to pay more out to cover the accident. So when they lose, the insurance company loses more, but they collect premium every month. It's the same concept. You keep collecting premium. Once in a while, when there's a loss, you have to pay out a bit more. But in the end, you still make money. Do you understand? This is the insurance business, okay? Insurance selling business. Now, so in this particular example, one contract that I trade, I collect 220 credit, $220, right? Now, what if I trade 2 contracts? If I trade 2 contracts, how much do I collect, guys? 440. If I trade 3 contracts, I collect $660. So you decide how many contracts you want to trade. The more contracts you trade, the more premium you get, right? You just multiply the contracts to get the desired premium. So later I'm going to talk about how I manage my risk. So of course, it's great to collect premium, but what if you've got a loss? The loss you suffer when there's an accident has to be manageable, right? So we'll talk about that in a while. Okay, just hold on for that. So far, are we okay with this thing? Okay, so let's just take one contract for now. Okay, now what does the trade look like? Let me show you. This is the profit and loss graph. Okay. Now, let me orientate you to how to read this. So on the y-axis, anything above this is profit. Okay, you're making money here. Can you see that? Anything below that, you are losing money. All right. So profit, loss. Follow so far? On the x-axis, this is the stock price. Okay. So right now, what is the stock price currently? Here, 690. That's the current stock price. So the stock price can go up, stock price can go down, right? Okay. So where is our strike price? We sold the put at 610. So can you see 610 over here? This is our point of no return. Our point of no return. So if the stock price drops below that, you lose money. You lose money, okay? So we cannot allow the stock price to drop below the point of no return, okay? Now, can you see this green line? This green line is the profit and loss at expiration, which is the 1st of October. So in 41 days, the profit and loss would be the green line. But for now, today, let's imagine it's Monday today. Can you see, let's imagine it's now the 23rd of August. The purple line tells you the profit and loss on this date here. All right. Let me let that sink in for a while. Okay. So after we enter the trade, let's take a look. Let's say we enter the trade and immediately, if the stock price suddenly drops and hits 610, what must we do, guys? If it hits our point of no return, what must we do the moment it is going to hit 610? You got to cut the loss, close the trade, right? So if I cut loss here, how much do I lose? Very simple. I'm going to put my mouse here. I'm going to put my mouse here, and the purple line is your profit and loss. Now, can you see this box here? Can you see the number on the box, the purple number? What does the purple number say? Can you see the purple number? It says minus what? 239. So there you go. So for this particular example, okay, if the stock price falls rapidly to 610, we cut loss, we will lose 239. This is our loss. Okay. If the stock price doesn't drop and the stock price remains there or goes up and hangs around here, at expiration, how much do I make? How much do I make at expiration? I'll make $220. That's right. So in this case, my credit is 220. My loss is 239. Is it within 1.5 times? Yes or no? Yes. So in this case, your loss is about, let's see, 239 divided by 220. You're losing about 1.08 times. You're losing 1.08 times, right? Now, it's not always so nice, all right? Most of the time, I wouldn't say most of the time, but there'll be times you will lose 1.5 times. So in your calculation, be prepared to lose 1.5 times when it's a loss. It will happen, okay? Now, here's the good news. As time passes, okay, as time passes, I'm going to click. Now, look at this box here. Can you see 23rd August? I go to 24th now. Can you see 24th? Can you see I go to 25th? Now, as we move in time forward, look at the purple line. What is happening to the purple line as we move towards expiration? What's happening to the purple line? The purple line is what? It is slowly going to the green line. That's right. Which is good for us, right? So as time passes, it's better and better because we will eventually keep the maximum profit. And as we move to expiration, the purple line moves up, which means we lose less money, even if it drops to the danger zone. Okay. So for example, you can see on the, let's say on the 29th of September, if the stock drops to 610 and we cut loss, how much do we lose now? Let me put my mouse on the purple line. What's the number? How much do we lose now? We lose 206, right? Which means we lose less than before. And on the 30th of September, how much do I lose? I lose 192, right? So as we go towards expiration, I lose less and less, even at the danger zone, okay? But I'll never let it reach the danger zone. The moment it gets there, I will get out. So I will not lose more than 1.5 times, okay? Now, whatever the case, you always want to close the trade before it expires. Strategy before expiration, okay? Always remember that this strategy, right? Like any strategy, you can't win all the time. You have got wins and losses. Now, even at a 75% win rate, you will have losses, right? You will have losses. So out of, say, 100 trades at a 75% win rate, it means your 75 wins and 25 losses. The trouble is you never know when the loss is going to come. You never know when the win is going to come. So each time you trade, you have to bet small. Please do not say, wow, this is a 75% win rate. I'm going to bet my house on one trade. Don't do that, because what if it was a losing trade? Okay? So you got to assume that you could have 1 or 2 losses in a row, or even 3 losses in a row. Okay? So let's use an example of this. So imagine you target to get a credit of C. So for winning trade, you collect C. Losing trade, you lose maximum of 1.5 C. You follow that? All right. So 25 times. So 25% of the time, when you lose 1.5, you're losing 37.5. 75 times C is 75C. So net, you're getting 37.5 C, which is basically a 50% profit margin. Think about it, right? You see, trading is like a business. In a business, you've got sales revenue, you got cost, and you got profit margin. So if you sell a shirt at $100, it costs you $50 to make the shirt. Your gross profit is $50. That's a profit margin. Same thing in trading. In trading, you will have sales and cost. In this case, your profit margin is 50%. That's a pretty good business. You can't say in trading, I only want sales. There's no cost. It doesn't make sense. No business has that, right? Now you may say, okay, Adam, what the hell is C? What's C mean? Okay, so let's put some numbers into this. So let's assume that every time you take a trade, you target a credit of $200. Okay, you target a credit of $200. Now again, if one contract is $50, what do? If one contract is $50, you have to take 4 contracts to make it $200, right? So you adjust the number of contracts so that you always target a certain credit. In my case, I always target $1,000 to $2,000 in my different accounts. Okay, so each win is $200. A loss would be times 1.5, which is minus 350. Okay, so let's plug in the numbers, right? So out of 100 trades, you win 75 trades of $200. That's 15 grand. You lose 25 trades of 300. Sorry, there's a bit of a typo here. Give me a sec. 200 times 1.5. Sorry, it's not 350, it's 300. My bad. 1.5 times 200 is 300. Okay, so that gives you a net profit of $7,500 for 100 trades. Okay, now, are you guys with me so far? So you can see that whatever trading strategy you use, it must have a statistical, profitable expectancy over the long run. Like I said, people who buy call options is like lottery tickets. Yes, they can score a big win once in a while, but in the long run, they always lose. Where in this strategy is different. This is not a lottery ticket strategy. This is a consistent strategy where over the long run, you always make money. because you're selling insurance. Make sense? This is my screenshot of my account, which I showed you guys yesterday as well. So for example, this over a 1 year period where I captured it, you can see my realized profits. This is from trading options. These unrealized are from my stock investments because I don't sell my stocks, right? I keep it. But these are closed trades from my options. And you can see made about 163 grand over, it's about 12 months. All right. That's about 13 grand a month. And I'm using about 200,000 of buying power for trading. All right. In my account, I use about 200K for trading and the rest I use for investing, right? So if you work it out, that's about 6.8% return. Okay. This is the first 4 months. January to May, was 67 grand profit. That's about 16K a month. So it's a very good first 4 months, actually. It's about 8%. All right. Last 2 months were a lot lower, right? Still profitable, but a lot lower, right? So, but the first 4 months were great months. Okay. So there are many trading strategies out there. Okay. Now, why do I like this strategy? Okay. By the way, I don't use, okay, whatever I just taught you is the bull put spread strategy. Personally, I use the bull put spread extreme strategy, which is a bit of a variation. The only difference is I sell the put very far away. Okay. And it's something that I teach in the options iron striker course. All right. In fact, let me show you my account over here. All right. So you can see over here, for example, these are all my cash secured put options. Can you see? This was what I talked about earlier. So you can see, for example, booking. I sold a put at 1950. I collected $19. So this is the average price of the premiums I collect. And after the premium drops, can you see it drops from 15 to 7, I make money. When the premium loses value, as it loses value, it all turns green eventually, right? And on this account, I trade the bull put spreads as well. These are bull put spread extremes, right? On Amazon, you can see on Salesforce, right? So for example, Salesforce, you can see I entered the trade at 48 cents, right? And now the options lose value is worth 14 cents. So as it falls in value, what happens? It becomes a net profit, right? So of course, I've got some which are like Roku is now losing like 1,005. But if when Roku starts to bounce back up, then you turn profitable as well. All right. Okay. So why do I like this strategy? Why do I like this strategy? Because number one, I like a strategy that does not rely on predicting the stock price direction accurately. How many of you have got this problem of predicting where the price is going? You say, I think it's going to go up. Then you buy a call or you buy the stock. It doesn't go up. It goes sideways. It constipates. Or worse, it goes down, takes out your stop loss and goes up. Freaking frustrating, right? But the good thing about this strategy is that you don't care. If it goes sideways, I make money. Even if it goes down, I still make money. As long as it doesn't collapse, then I got to cut my loss, right? The second thing is this strategy is mathematically proven to have a high win rate, right? Why? Because when you're selling options, 80% of options expire worthless. It's a fact, all right? So based on delta, you have a very high win rate, okay? And the third thing is that it only requires minimum time commitment, right? You know, at the most 1 to 2 hours a day. So I've got many traders who still have a full-time job, all right, or running their own business and doing this as a full-time business as well. So this is one of the, I always say trading is one of the best businesses in the world. Why? Because you can do it from home. You don't need an office. You don't need staff. You don't need inventory. Screw all that. And you're like an insurance company working from home, selling insurance. Once in a while, you got to claim, you got to pay the claim, but in the long run, you're going to make money if you manage your risk very well, right? And I think Bang has showed you a lot of testimonials, so I won't go through all of them, but I've got all these people, right? I think this is Jason, right? It says, this is my options trading account. It's a small account. I started with 2,000 in January, added 12K in February. Now it's about 50 grand, right? All investors need to understand options. It will help you to minimize your risk and maximize your return. If you don't understand options, it's like going to war with a knife and spear, right? And yeah, so it's up like 40 grand, right? Within the first year of taking this course. And, a lot more, right? We've got all these students of ours, right? So Bang showed you one technique this morning, which is diagonal spread. I've showed you two more, cash secured puts and bull put spreads. But you know what? There are a lot more, right? In fact, there's more than 16 right now. I think there's about 19 or 20 strategies in total that we teach in the two courses, right? Now, the thing about it is you don't only trade options on stocks. You can trade options on ETFs, trade options on indexes, trade options on futures like oil futures, gold futures. You can also trade options on currencies. So, it's very flexible, okay? So wherever the market is, okay? So for example, if the market is slightly bullish, you're not that convinced it's going up, but it's a bit bullish, you use bull put spread extreme, and cash secured puts, right? And diagonal spreads, right? But if you're very bullish, it is really going up, you use bullish synthetic or the bull bang or bull call spread or callback ratios. If it's going sideways, going nowhere, you use diagonal spreads, or you sell covered calls, or you use calendar spreads, you use iron condors. For special events like earnings, you use earnings sniper spread. So why do you learn all these tools like a Swiss Army knife? Because wherever the market is, you don't complain, the market's going sideways. No worries, there's a way to make money. The market's going down, there's always a way to make money once you've got these tools, right? And blah 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 blah. I'm not going to go through all these testimonials, just a lot of it. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.